Hey, what you doing? Y'all having a good week? So we don't really have any topics of interest at this point. I think we're just gonna take a look around then, since nobody really had any requests, and maybe just see what we see. Really, it looks like the market's still waiting on something. I don't really see any reason to guess on what it is, but we can take a look around, see what we find. We had some talks about watch lists and scanners last week, and we didn't get into it. But when I was new, one of the lists that I used a lot was the Dow Jones, and there's some simple logic behind it. It's blue chip companies that've been around for a long time, and while they do cycle names out when they reweigh it, it doesn't happen often, and even when the names get cycled out, it's not likely that they're just gonna, disappear or go under as a company. So it doesn't have a lot of revolution out of it. They're typically really good companies. That doesn't mean that their options are really good, but most of the names I think that are in the Dow would be household names, certainly recognizable, and it gives you a good starting point. It also is really diverse. So, it covers a lot of different sectors and industries. It's just all around a decent watch list if you're newer to trading and especially wanting to get deeper into swing trading. It's not a bad idea to cycle through the Dow. It's 30 names, so it's easy to keep up with. You can evaluate them on a day to day basis, and it helps with consistency and routine. Course, there's the Nasdaq 100 or the S&P 100, and there's a lot of names that are in those two that are also in the Dow, but it is 100 names, so then you start getting into a broader selection of stocks. Energy's still getting a lot of unusual options activity, and then of course we're getting some trash as usual. Nvidia held that breakout bar, the 50% mark at least. And it's something that I've been keeping an eye on today because I thought, well, if we break the mid, we'd have a nice short in NVIDIA from like 162.5 down to 160 maybe, near this Globex low candle right here. Be a little short-term trade. The thing is chips aren't doing all that bad, so trying to catch a short in Nvidia kind of implies you think you got a short in the chips in general. It's not necessarily working out that well at the moment. But I've been watching that level just in case. If this scoop pattern plays out, the S&P and the Nasdaq should be able to make it back up to previous highs and then get a breakout equal to the dip, which would be nice. It's funny, we were talking about the dip today, and a new trader was saying one thing he's learned is just buy the dip. And yeah, I mean, that's not far off the mark, really, but it's a little more complicated than that, right? If you think about times when that may have not been a good idea. The 2022 bear market, for an example, was not a good time to buy the dip. And it took people a long time to figure that out, funny enough. That we get so accustomed to buying the dip that when we actually do get a considerable sell off and a reason to be selling off, which is a big part of it, people don't believe it. And then they just keep getting run over and run over and run over. I saw the same thing during COVID. A good friend of mine blew up a $200,000 account during COVID because he was trying to buy the dip, and he was just moving away from stocks and options and getting into futures. And so he was way more leveraged, and he was swing trading futures. So it didn't work out too good for him. But if you think about how often buy the dip works, it's a really good trade strategy most of the time. And it's worth doing nearly any time because worst comes to worst, you're just going to get a trade that doesn't work, right? We can't run around being scared of a losing trade because losing is inevitable. You're going to get a loss. The key to the whole thing is just, not losing more than you win consistently. So maybe that's something we could evaluate today. So there are historic precedent when it comes to buying the dip, how many dips we get, how big those dips are, and what sort of returns you get after buying them. Generally speaking, there's a rule of thumb for what we call a bear market. Some of these rules have changed over the years to have different parameters, but they're kind of consistent. So one of those would be how far off of the high we are. And this mostly applies to indexes, but I've seen it applied to stocks as well. Sectors like XLF or XLK, XLY, those sort of things. You would want to measure the last high that we had and then measure the depth of the pullback. And if we exceed 11%, then they consider it bear market territory. Now, some places won't necessarily call it a bear market, they'll call it a correction or a deep correction, and they won't get into quote bear market labels until you have multiples. So, say the NASDAQ moves really fast and drops below that 11% threshold, but the Dow and the S&P aren't there yet. A lot of analysts will say, "Ah, we're just in correction because only one index has dropped below that 11% number." So you can get really nuanced with it, right? At the end of the day, but it doesn't really matter, right? The main thing, whether we call something a bear market or not, or if it's just a deep pullback or correction, is what are we going to do with it? And when can we do something with it? So if you go back and evaluate some of the biggest drops we've had over the last, say, 25 years, you'll see that all of them were opportunities to buy, right? Because that's just the market in general. It is worth noting that someday, eventually, maybe we won't come back up again, right? It's happened to other countries. It could certainly happen to us, but I don't see that we're there anytime soon. So even when you do, buy it on the dip and it stays down for a long period of time, as long as you're not messing with something that expires, like options, and you're staying in companies that aren't going to go under or get absorbed through M&A deals, then you can just ride it out. When it comes to swing trading, however, if you are just bag holding forever, that's not a trade anymore. That's an investment. You own that thing, right? So, there's got to be some way out of it. And then there's a lot of research that suggests that buy and hold doesn't work. The idea being that if you just buy and buy and buy and you never let go, then you're not actually accumulating anything because it's all paper wealth until you sell. And at any one point, you could decide that you're going to retire in 2022, for an example, which I knew a lot of people who were going to retire in 2022, and it ended up being a bear market year. And now they're getting ready to retire on a down year, and the market's 1,000 points off of its highs. So, you know, if you're buying and holding for 40 years and then you go to retire and the market has just taken a 20% correction, that's 20% of your retirement that just went up in smoke. Well, that's not nice. So I like taking profit, right? Locking in those gains so that I don't have to worry about losing them later. And I also like buying on the lows. Take the current market conditions for an example. When we started to sell off, I was putting in the chat my different buy zones from the first of the year. And there wasn't really a lot of magic behind it, right? I had an area along here, this 5,800 area. Actually, I think it was a little lower than that, right? I think it was somewhere in here. I bought some, I went long, and then I think I went long in here. And I was planning to go long again somewhere down here, but we didn't get there. So I didn't get the low, but I did get two different tranches of buying opportunities. And to spread it out a little bit, rather than trying to be a stock picker in that situation, I just went in and was using mutual funds. They're vague, they're a bit thematic, so you can, point them in a general area. And what I used in these two instances, one was large cap stock mutual fund, and the other one was a mega cap stock mutual fund. Those are basically Dow stocks, right? I'm sure if I open the mutual fund up, it's not all Dow, but you kind of get the idea. Mag 7, hyperscalers, Dow Jones, blue chip companies, big mega stock companies, and it worked out pretty good. I had marked out my zones to buy, and I had every intention of buying until we started to come back up again. That was my goal. Now that we have and we've exceeded the previous highs, I've unloaded some of that. I still have a little, but like I said, I like to take money off, put it in my pocket because the next opportunity to get a buy the dip might just be one of these little pullbacks, which is fine. Take what we can get. But it could be a pullback that actually exceeds this previous level. I don't know. You don't know. Nobody does. And we just got to have plans for that. Before COVID, we had this system where the S&P would get a 5 to 7% pullback. So less than the 11 or 10 level that we were talking about a little bit ago. And those were famous buying opportunities. Let's see if we can pull the chart back a little bit to capture some of that without all the shenanigans from nowadays. These opportunities here, that's a 12% pullback. So that's a bit more than we're looking for. Let me adjust this. Thought I did that already. Turn that off. Set it as default. Yeah. So I was 12%. I think this one was deeper. This was the year that I started trading in 2018. I haven't been doing this as long as some of the others. That's a 20% pullback, but these smaller ones were really good buy low, sell high opportunities. It's 3.25, 4%. Those are just really good things to be mindful of, right? Here we had 7 and less than 8, less than 7. You kind of get the idea. So buy low, sell high, buy on the pullback. They're not a bad way to go. And there's always a lot of fear, a lot of angst in the market, all these bricks in the wall of worry that makes you think, that everything's bad and we're going to go down. And I know really solid analysts that were saying we were in a bear market and that this was just a dip or just a pullback. It was what were their phrases? This is a bullish impulse in a bear market. That was the words that I was hearing out of quote famous analysts all the way up until we got above this level. And then all the way up here, they were like, well, I think maybe this is actually done and we're going to go back to the highs. Like, really? You waited until all the way up there? There were tradable opportunities down here. And as I'd already mentioned, in my longer term buy and hold, I had already bought some there and some in here somewhere. Longer term buy and hold is a lot easier to play, right? You set it and forget it. You barely look at it. At least that's what I tend to do so that I don't mess with it too much and just leave it alone. Trading on a longer term is the next easier thing. But generally, we need some sort of trigger or catalyst or reason to get in, and then defining the trade. And this is where I see a lot of people having issues. And you see it in chat, right? If you go to YouTube and look at the comments underneath people's videos, there are a lot of people that are just lost. And their comments are usually, hey, I got this trade back when blah, blah, blah. And now what do I do with it? Either because it's winning and they have no idea if they should get out, or because it's losing and they have no idea if they should get out. And I always feel bad for those people because no matter what answer you give them, they're not going to be happy. If they get out of a winner and it continues to run, they're going to say, why did I get out? Why did I listen to that guy? I should have stayed in. I could be making more money. And if they're losing and they get out and it turns around and goes the other way, again, they're going to be complaining, oh, I should have stayed in. My loss would have been lower. Why did I listen to that guy? But what I've seen over the years is that a lot of people will ask those questions so that they don't have to take the responsibility of the outcome. It's not my fault the trade lost. He told me to get out. It's not my fault I didn't make enough money. He told me to get out. So on these trades, you really want to have an idea of how you're going to manage it before you get in. It helps a lot. One, it'll help you improve later, and it doesn't have to be something very specific to the T with every tiny little detail. It could be something just as vague as, hey, I've got this higher low here, and as long as we don't get a daily close below that level, I'm going to stay in my long trade until we get back above that level. That's not too vague and it's not too specific. It gives me some wiggle room, right? And then having some rules in place for how to deal with some things like, well, I got this trade, it lasted longer than I thought, and now we've got FOMC in 2 weeks. I'm getting a little nervous. Maybe I need to lighten my load because I've got threats coming that I didn't expect when I put the trade on. You can have rules like that can get you out of the trade, not because price has done something, but because we now have a threat that we didn't have before. Those sort of rules can really help out. Try not to squeeze every penny out of every trade either. That goes a long ways. Trying to hold on for more has cost me more money than it's ever made me, especially when it comes to options. There's nothing wrong with leaving a runner, but a lot of options are so expensive that we don't get multiples. We just get one, you know, one contract, $9,000, and it makes 10, 12, 15%. And instead of taking the money and getting out, get greedy, hang on too long, give up our gains, worse, maybe even go in the red. So, having rules on where to get out on profit helps if you focus on percentages. I know a lot of people aren't happy with math, but use quarters, right? 25% profit, 50% profit. I like to use dimes, 10%, 20%, 30%. But, you do you. Having something is absolutely better than having nothing. And then just be willing to adjust your rules after you've closed a trade. Evaluate how the trade went, really think it through. Did you like how everything went? Did you have any blind spots that need to be addressed? And then work on the next thing. Your win rate is directly connected to your profit and loss and risk to reward. So if you're aiming for more money or you're trying to aim for a higher risk reward, you'll lose more often. That's sort of the quiet part of risk to reward that most traders don't mention, but it's just a fact of life. So all the textbooks tell you you should go for like a 2 to 1. It sounds great, but a 1 to 1 requires at least X amount of win rate. 2 to 1, you have to have even more wins. 3 to 1, higher and higher and higher. So you will lose more often if you aim for more. Look at your current win rate, especially as an options trader. If you're losing options at more than 50% of the chances you take, try lowering your profit targets. So I'll give you guys a good example of this. Was talking to a day trader a while back. I don't know that he's still here anymore, but he was a day trader who would sometimes hold for the end of the week, right? So not a long-term swing trader and really just swinging for a couple of days if he was swinging at all. Most of the time in and out in the same day. He was using options that would expire within 10 days, so he wasn't using 0-day options. And he was winning around 60% of the time. But his wins weren't really good, and his losses were really kicking his butt. So the 60% wasn't working out. When we went in and looked at what he was doing, he was aiming for a high win rate, a high profit. Excuse me. He was hanging out, trying to get a high profit, which he was missing, and then he was closing them at a low profit. So at first glance, when I seen his profit average was around 22 to 27%, I thought, man, you have a really low win rate for such a low profit target, 25% profit. You should be hitting something in the high 70s. And then I found out his profit was low because he was staying in a trade after it reached its peak. And then that profit target was falling back down and he was closing it somewhere down here when he could have been catching it somewhere, on the way up. So we started to reevaluate those profit targets and the win rate associated with it. So if you start taking short-term options trades using, well, let's say $1 options just for some easy math, you buy a $1 option and you hold it for 15% profit. Simple math. If it's a dollar and you're holding it for 15-cent profit, it's 15 cents, right? 15%, 15 cents. You're in, you're out. Now, sure, you just risked a dollar to make 15 cents, but did you really risk a dollar? You spent a dollar, but you didn't necessarily risk the whole dollar because you could have got out at any time in a loss. You have to have a loss factor in there somewhere, say half. So now you're risking 50 cents to make 15 cents. Still doesn't sound that great, but if you trigger stops on options or if you're just bailing out every time they turn a little red, you're going to just lock in losses that you didn't need to take, right? So when we changed his numbers around, he was taking profit and getting out of trades really fast because he was trading intraday momentum. He had a nice trade strategy. It was catching moves really well. And if the move didn't work, it fizzled out really fast. So he could tell from the stock chart, hey, my trade ain't working. And then rather than waiting on the option to get to a loss level that he didn't like, he just jumped out of the trade, right? Because price wasn't doing what it was supposed to do, and he would just get out. But 15% profit was closing a trade like that fast. getting in at the open, for an example, and he's out in 15 minutes and he's leaving all this behind. So that's where journaling came in. He traded that 15% profit target for a week and a half, I believe. And we looked at his win rate, his loss rate, the amount of loss when he did lose versus the amount of profit when he won. And he had a really high win rate. I don't remember the number now, but it was a really high win rate. But he didn't have a lot of profit, as you can imagine, because he was closing them at 15%. So once you've got your win rate established, which is what we were working on with him, now it's time to start bringing the money back. But you can't do it all at once. He's already shown with the high win rate that his strategy is working. It's not it's not a broken strategy. Now we start increasing the profit targets. Instead of 15, go for 20. Run that for a week. As long as you're still maintaining a high win rate, take it to 25. Run it another week. You keep doing that until your losses start to increase into a significant level that you can't sustain. 50% losses, 40% losses, whatever your number is. I think he was triggering into his loss rate when he got into the high 40s. It was just the way his intraday strategy worked. So he backed off and was taking 35% profit consistently. And even though his loss stop was set at 50%, his average loss was actually less than 30. So that was working out good for him. And with a high win rate, his problem was solved. He was killing it. Sure, all of that is a talk on options and day trades, but the same tactic applies for swing trades, for futures, for anything. You've got multiple things to fiddle with. One is your profit target, how much money you're making per trade, and your loss. And then one is your win rate, but they are connected. So if your win rate sucks, if you're losing more than 50%, and your risk to reward is bad, say you're risking 3 to make 1, you will not survive, right? Your account won't work. You're going to blow it up. You'll fail over and over and over and over again. Start to adjust one of those at a time. Preferably, work on the win rate first because you got to have the wins, knowing that your strategy actually works. And then dial in the profit afterwards. So if you're doing futures, right, you would close the trade at a low profit target, just focusing on the idea that your entries are good. You're not getting ripped apart by a wide bid ask spread. You're going in the right direction. You're managing the position correctly, and that you can get in and out and get your very small profit target 15%, 20%, whatever you're aiming for. And if you don't want to use percentages in futures, it makes sense, right? Just use points. Once you've got your win rate established, start increasing your profit targets. You'll know when you went too far because you'll start to lose frequently again. And then you just dial it back a little bit. It looked like we were going to try to sell off, but we didn't get it. Not much of a surprise. We didn't get much of a catalyst. And the 10-year turned around. I don't know if you guys saw that. It's a little wild. So we're headed back down. This collar idea is still broken, right? If we're thinking about how the 10-year should maintain this range and not get too out of control, like it was back during the Liberation Day event was way down here at like 3.9. So we didn't get that low, but we got near the lows, turned it around, started running it back up. This is the range that we expect the 10-year to maintain. And as long as it's doing that and it doesn't get too far out of control, it's fine. This is what it's supposed to do. That's out of control up there, and that's out of control down there. So as long as it just toes the line, we're fine. The thing is, as I've mentioned before, location is one thing, and it's an important thing, knowing where the collar is. But the other part of it is how fast are we moving on a day-to-day basis? The rate of change. And the rate of change got a little wild today. It's not too bad compared to like that day right there. That was a really big day. But the day's not done, and it got a little wild. We got through the auction that we had. Market's still here. We're still topped out in crude and in the dollar. And I believe that those two are very likely going to move, uh, not necessarily in sync, but in step. We should see the dollar fade with crude and gold resume its upward move. That's the way it's supposed to go. If we don't get that and we continue to see the dollar heading to the upside, I would say continue to look for gold and silver weakness. So if you are trading precious metals, silver, gold, those guys, really just kind of keep your eye on the dollar. It's not tick for tick. You don't have to take it down to an intraday and stare at it consistently, but just get a good outline of what's up with the dollar. Let's just overlay gold here. We'll just use GLD. Don't need to get wild with it. So I got GLD in pink. I did that wrong. There we go. And you can see how they're inverse of each other. Gold's at the highs, dollars at the lows. And now that we're starting to lift up in the dollar, gold is flattened out. It hasn't quite dipped down yet, but that's what we want to be mindful of. The concern is that we're going to flip and we'll get, the dollar heading back up, and this is gold here. Now, it's not going to be forever, right? These products, um, and this comparison and this analysis is about the current market environment and the current administration and global policies and just a lot of stuff, right? So you can't put this in some memo box that says, oh, well, these two always trade inverse of each other. So 5 years from now, I'm going to trade gold while looking at the dollar. You don't want to do that. You want to evaluate what's going on with the dollar at that time. Why is it moving? Why is it doing what it's doing? The current administration has really been pushing for a lower dollar. It's a part of the whole 333 plan that they put together when they got elected. So its influence on precious metals is due to the current situation. It's not going to be like this always. A little bit of a tell is that we didn't get that breakout in gold when dollar had that last hurrah to the downside. I guess that should have been a warning to all of us that there was going to be some issues right there. I loaded a trade yesterday in this, which is On Holdings. It's a semiconductor, I believe. No, foot. Yeah, that's right. This is the Nike Foot Locker apparel short. Not On is the other one, right? I always get those two confused. Yeah, that's the semiconductors. So On, I got filled in a $40 put in this for September at 40 cents. I put the trade on as a working order earlier this week and honestly forgot all about it. But this space is trash, right? Nike, footwear, Foot Locker, just the whole thing. Boot, um, yeah, all of them. So get to a chart that doesn't have all that stuff on it. This is on the daily, and you can see this range that we've been playing. The concern is that it's not going to break this half, and that my put trade will be wrong. But I got my put on the up day, which is good. I was trying to put it on Monday. It didn't fill. I set my price to something that never filled yesterday, and then I got filled today on the run up. And what I'm looking for is a breakdown out of this range and a continuation to the downside. The concern, of course, is earnings, but it's all right. It's a September trade, so I've got time. The I got September 19 40 strike put, and I got it for 40 cents. We'll see how it goes. I think this is I think the whole space is weak. This is the trade right there. Yeah, it's a funny little indicator. I found it today. Um, it's targeting high volume support and resistance levels, and then it's putting these clouds around the volume and highlights the highest volume bar. I don't know. I'm just checking it out, right? Because every day there's new indicators on TradingView, and I don't know. You never know what they can do until you go in and check them out. So I've been just kicking the tires with it today. To me, it's noisy and it gets in the way, and I'm always trying to like look past it, so I don't really like it. But keep it around for a little bit. It is interesting if you start to read it. It starts late, so it doesn't start on the candle that created it. And if you followed that across, that was a high volume bar from back here. It's where we got the greatest amount of volume on the day, right? We dropped down into that and they responded. It was those guys responding right there. And there's another one, of course, down here. If we did get down there today, which is kind of one thing I've been looking at, how's it going to respond? And or back up at the highs. We'll see. I was feeling around with it. So what I do when I'm checking out new indicators is go to on TradingView, go to community, and look at the editor's pick. It's not necessarily quote the newest stuff. um, but it's ones that they've already looked at, right? So if you don't go that route and you start looking into the top ones or the trending ones, you'll get some that have errors and they're still working the bugs out and looking for people to provide that insight. I'm not really interested in being, you know, a beta tester. I want something that already works. And you can find some really good stuff in here. It's good for analysis, right? I don't trade with trade triggers or trade, based on indicators. I guess that's a better way to say it. But using indicators for analysis has always been, something I like. So I'm just checking it out. So Amazon's been putting in this topping pattern since like the 30th. Been keeping my eye on this one, looking to see if we're going to leave that top. I guess it'd help if we were on a daily. So back here, we were paused. It felt longer than that. I swear it did. A little bit of a dip, and then another 3 days where we just weren't able to get through that level, down again. When we finally did get through it and we ran up, it was like this big gap away, but it already came down and closed the gap. So no reason to sell off from there. And then we've been putting in this structure here. Well, I really I thought we were ready to go yesterday, right? On that run to the downside. And then it opened gapped up. So now we're inside day, and it's a it's a tease at this point. GTFO, right? We got to get out of the box. I don't mind trying to sell it off of the highs if that's the way we're going to go. Wow, what? There we go. Trying to sell it off the highs, I'm down for that, but we just didn't get a chance. So an intraday run back up today, buying puts around that high, that 224, 225 area, I'd be down to try it out. But I don't want to buy calls on a green day, especially, when we're sitting in the middle of the range. So if we can get along these lows again, I'm willing to get some calls. Or if we get across these highs, I'm willing to get some puts. Actually, let me save this the way it's supposed to be saved. So I mentioned we can do a deep dive, take a look around the market, see what's out there, and if there's any cracks or stress or something to be worried about, we can do that. And or we can go shopping around for tradable opportunities. It's up to you guys, whichever way you want to go. I can tell you now that when it comes to the macro backdrop, while there are a few risk signals, everything's still screaming bullish. Nothing is showing a short signal or a short trigger, and nothing is saying it's time to get out of the pool of the long trades. So we can go look, but that's the general takeaway at this point. Having said that, it doesn't necessarily mean that we're good to go for longs either. We are hitting in the upper percentile, and while there's room to go farther, we've already made a really good run. All right. So this is just a simple moving average chart. I don't think I've got anything else on here. Oh, volume. The purple dotted line is the 200 simple moving average. That's a little weird. Something's purple here that shouldn't be there. Haha, and fixed it. All right, and the purple line that's not dotted is your regular EMA 200. The reason I do that is because on a weekly chart, I want the 200 EMA weekly, but on a daily chart, I want the 200 SMA daily. So I just keep them both on there. To help solve the argument of what's better, the EMA or the SMA, I've proven over the years it doesn't matter. And if you don't believe me, you should load both SMA and EMA and run them for a couple months, and you'll get to the same conclusion. It really doesn't matter. In this instance, I'm just being a little picky. I want the SMA on a daily. That's it. So if we start looking through some of the Dow names, Apple's got issues, and everybody loves to hate Apple when it's down. It's one of these cult following companies that when it's at the highs, all the analysts are screaming that it's a buy, and they all own it. It's in your 401k. It's in everybody's company wide 401ks. Everybody's got the bonds. Everybody loves it. But man, if it has any weakness and it heads to the downside, they pile on and talk trash about how this is the end. It's finally done. Blah 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 blah. And right now, it's no different. I was listening to Bloomberg this morning, and they were talking about the end of Apple and how it was gonna, get removed from the Mag 7 and eventually get knocked off of the Dow. Come on. I mean, sure, all empires come to an end, but it's not going to happen until at least 2030s sometime, as far as I can see. This is no different. So, Mark Zuckerberg has been stealing employees from other companies, and he has offered some of these employees $100 million sign-on bonuses to leave their current company and come work for him. I mean, that's tempting, right? $100 million sign-on bonuses. He didn't offer all of them that, obviously, but there's been a couple. So he's stealing top talent from Google, Apple, and Apple also is losing its number two in charge. And of course, it's got issues with China. It's fighting with the current um, president about tariffs, and the EU's going after it, and it's got issues with its phone and AI, and now they're changing direction and they're going to hire or buy an AI to put into their phone. They've got issues. They are under the 200-day moving average, and they're close to the 400. When we put it on a weekly, the weekly 400 is the line in the sand between a company that has hope and a company that's just straight up broke, like UNH. That thing is broke, yeah. So this ain't that. Um, but it has reached the 200 week. And for Apple, that's a really big deal. I didn't get some on the week that it hit that 180 area, but I did get some a little later. And I'm very likely going to get some more. if we break this weekly wedge, textbook wedge, by the way, with a really nice pop out. But the pop out only got us back to the high of that wedge, and that's all it owes us. And so now the pattern is done, and we need a new pattern, basically. This one has given us all it's going to give us. So I wouldn't mind buying some more of it if we get a chance back along these lows, that 200 area. Otherwise, if you're watching Apple, the midpoint of last week, which is the breakout bar, no less, which makes it even better for this analysis. It's 207 basically, right? We can give away a couple pennies. That is the mid level that we want to close on for the week because it's a weekly measurement. At the end of the week, we want price to be above 207. So we can dip down and we can, come back up and all's good. If we do close under there by Friday, on Monday, we need to open above it and stay above it. And the reason I say that is because just in case we get one of those Fridays where we really sell off and we run back up and we close, at like 206 and a half. I don't want everybody saying, oh, we closed underneath it. We got to short it. Yeah, closing underneath it is the first part. How we open next week after we close underneath it will be the second part. So if we close underneath it, instead of using my drawings, let's use these fancy ones. They're in there somewhere. There it is. So if we close under here, how we open next week is going to be really important. We'll just stop right there. Ghost bars. Ain't that cool? Try to tighten it up a little bit. There we go. That's what we want to be watching for. So say this bar is Friday, even though, it's not, whatever. That bar is Friday. And the next week on Monday, if we open gapped up against that pivot point and then we fall all day and we're going to close at the lows, I would really like it for a continuation short. So how we open after closing underneath it is going to be a big deal. But if we open like that, we close on Friday near the edge, and then we gap up on Monday and we're above it, and we run up and we close at the high. I mean, that is not a short, right? So one piece of this is how Apple closes this week and whether or not it closes above the midpoint of that breakout bar. And then if we do close above it, we can stay here and chop. It would be what Adam Grimes calls a pre-consolidation breakout. We could like stay in this zone, but we're really focused on the next breakout or the continuation of the first breakout, which will be getting through this big bar and all that trash back here. We got to get through all those sellers right there. And then, of course, if we can get through that, we'll focus on the next level. For this bar that I just marked out, you could just take fibs again. It's the same tactic, right? Get the mid of that because that's the midpoint we got to get through. And it's also where they couldn't get through. So it lines out really nice. So one step at a time. Apple is giving us some opportunities. If we can hold above 207 and then we get a breakout above 215, we can use price target at 223 or 222. There is a longer term trend line that we have to be mindful of, but it'll be up here at 223 anyways, or 222. So it's not necessarily a problem at this point. What is a problem though is this earnings that's coming up. If they have earnings and their spending is still out of control with the current results that we've been seeing out of their AI department, I think we're going to retest this 200-week moving average, which if we do, I'm willing to buy it along that low, right? I think this whole zone down here, I'm willing to own that. So just be mindful of its earnings. Um, it's easy to hate Apple if you're reading headlines and articles and they're all poo-pooing over it. One little trick that somebody told me about Apple is if you find a headline where somebody's trashing it, Google their name and look for articles that they wrote when Google was breaking out into new highs, or when it was making, or not Google, yeah, Google Apple when it was making those new highs, and look for it when it was doing that kind of run. Why does it do that? That drive me crazy. There we go. See what those same people were saying when Apple was making runs like that. Because what you'll find most of the time is the ones that's hating on them when they're down are the same ones that were screaming about buying it at all-time highs. Because people just love to hate on Apple. Microsoft, on the other hand, which is another name in the Dow, everybody loves it. It's doing fantastic and it's not slowing down yet, but there is a threat about earnings. And of course, you got the dividend right behind that. I really like this name. And so far, there's no threat here. I did put in the chat that I was looking for a possible 3-bar reversal. And this is what I was looking for. This sort of a 3-bar move right there. Let's see if we can zoom into that a little bit. Guess we'll do it old school. That's sort of a gap play is what I was looking for. There's no gap in this one, but I just scrolled back a little bit to find an example. It would be better if we had gapped up and then ran and then dumped. But I was looking at Microsoft this morning and I was thinking this was a really good start for that play, for a weekly play, right? Let's go back to a daily. You see how we went red to green? Yeah, I like red to greens. Those are fun. All right. So we still have this untapped gap. And then we had these two IX 10 days inside of that big bar. And then we went red to green. And my expectation was that we'd get this loop, right? Now we didn't get the loop so far because it's still green. If we did get the loop, we would be targeting the close down here, right? We just don't have that. And it would be the start of that weekly bar coming down, which is what I wrote about in the chat this morning. That's really what I'm focused on. Now, for that weekly bar, we're not done yet. You know, the week ain't over. We could see something a lot uglier, and so far we just don't have it, and we're still outside of last week's range. So we don't even have the break back inside, or the breakout failure at this point. So it's easy to look at Microsoft for a short when you look at that weekly and how far it's come. But here's my caution: don't try to short Microsoft yet. Have an established pattern or reason for the short. And I say that because on the week, it just keeps going and going, and it looks like it owes us a reversal at any moment. But even on that one reversal bar that we got, and it wasn't even a good reversal bar, it was just a red doji. Even with that one bar, it just kept going. No short, right? And look at the gap up from that red week. That's a weekly gap up, and weekly gap up is really bullish. And we don't have any reason to refute that yet, which is why I'm looking for an established reversal pattern that we can play, and we don't have it, not yet. And if you look at it on the daily, we're leaving a lot of gaps behind, and we pause after big runs like this. We paused, and that's really healthy. It's not overextended at all. It Every time it pauses like this, it heals so that it can make another run. And that means we can't short into it yet without getting our face ripped off again and again and again. Now, if you want to go for a longer term short, like a September or October put, it's fine. Get something far out in time and far out of the money, and it just be like a gas station lottery ticket. And if you can get it for 2 or 3 pennies, so what? Why not? Why not? But there's no short signal here. If you are looking for like butterfly targets, which is not necessarily a bad idea, 450 puts, 400 puts, 350 puts, that would be my flavor. It lines up on key structural levels. They're big options plays, and you'd be better off doing those because you really could keep the cost down doing it that way. You could probably get pretty wide, and I don't know, we can shop around and see what those look like. Because if we do get that reversal in Microsoft, it would be good to know what the prices are. So here's Microsoft. Um, let's just do the normal first. Where's the volume? If you haven't seen me do this before, I'll just apologize now. You want to keep your eye on this column on the way down and on this column on the way back up. It's a little tactic that I do, especially when I'm in a hurry in the daytime and I'm looking for a lot of information. All right, August, it's got a little bit. October, far out of the money in October, which is good. I'm glad we've got something more than just July and August. All right, so that was the put side. Thinkorswim glitched out on me. Really, not a lot on the call side. January 2026. That's a bit far out. October, September, August. August has nothing. All right, so they're doing some shenanigans with a August put, September calls, and then they've got these October calls that are coming in, and then really far out January stuff. They're matching. It's like a big spread. Meh. So position wise for us, not looking for a long term crash and burn, right? Something like August expiry, maybe into September, we start getting into those potential rate cuts. So I would look for some August prices first, see what we can get on a butterfly for around 450. Oh, $9, but it's only 5 wide. So if we wanted to widen it out, we'd probably have to go to the 400 strike. Yeah, $2. Now we can widen it out. All right, $15 wide butterfly for $10. It's not bad. Now, if you put on something like this and it starts to lose, first of all, consider this is going to be 100% loss if you're wrong, right? You're not going to get your $9 back. So don't go in and buy 50 of these, right? And if you do want multiples, buy a couple now at less than 10. And if you're committed to the cause, buy a couple more if it loses 50% profit. So say you buy 5 of them at $10, you buy another 5 of them at $5. Because if it starts to get soft now, it could still reach that target later if they cut, um, if Microsoft has a bad earnings, all kinds of reasons, right? So August isn't bad. I would have liked better. And if you really wanted to get out there, you could try something like a 350 put butterfly. These don't have any volume. So I don't know. I just seen that. No volume. You're not going to get filled out there unless you offer some crazy amount of money. So let's try September and see if it's got any volume. Yeah, a little. Looks like they're putting on some ratio spreads out here. 1 penny, $5 wide. You can make it 50 points wide and spend 50 cents. This would be your butterfly. If Microsoft lands anywhere between $400 and $300, you'll start to see profit. The max profit is around $49,000. I'll just $4,900. I'll just say now you'll never hit max on these, right? You can get 70% or 80% if you're having a really good trade, but most of the time, I would say you want to aim for like 15 to 20%. But still, 20% of basically $5,000 is not a bad trade, right? Doesn't sound that bad to me. But still, this would require a significant sell off, and you're out, $53 if you're wrong. Now, don't get me wrong, I've racked up bar tabs easily exceeding $50. It's not like we're putting a lot of money on the line here, but small accounts, you really got to consider if you want to risk $50 on this because we have no reason for a short here, right? We're looking at a butterfly at the 350 area for September just because. It would be different if we were risking $50 and we had some sort of macro trigger or, you know, a bearish trend or a bullish trend. We got no reason for the butterfly other than, we've been running hard to the upside and sooner or later they're going to get whacked. I'd like to continue the argument that we don't have all those bearish signals, right? Um, Even my Microsoft post from today was just a heads up on hey, watch out, we could begin to see an evening star reversal on Microsoft. I'd be really excited if we got it. We ain't got it. So continue to shop around for long trades. Now, by now, you guys have probably heard me say enough that I don't like to buy calls when we're green, and I don't like to buy puts when we're red. But that's more of a short term trade. If I'm looking longer term, sometimes you just got to go with whatever it is that we're working with. Google, Microsoft, Apple, and I'd rather trade Apple in this scenario for what I'm about to say. Some long option positions would not be out of line. For one reason, most of the people that I talk to are bearish because we've run so far. Well, how's that working out for you? Right? It's not working. So staying long is a proper course. CTAs are long and continuing to increase their long position. We've got stock buybacks coming out of the blackout period soon. We've got VC funds that are continuing to buy as long as volatility falls. There's just a lot of auto buying going on, and we're through with the window dressing from the quarter. As long as banks start this earnings season properly, meaning not negatively, I think we could continue to go up, and it would be squeezing all these retailers that are trying to short Microsoft, Google, Amazon, because it ain't working. Them people buying to close would add to the buying pressure, and I think we just go up even more. Let's look at some dealer positioning. I think that would help sort of provide some clarity on where the institutions are versus where the retail trader is. I got to get logged in. What I'm going to look at is trading ticks. And I think you can use the command here in the Discord to do this, but it's faster for me just to do it on the website. So here's NVIDIA. Dealer positioning is down in the bottom. If the dealers are net negative, it'll be red. And if the dealers are red, then retail is green, right? You and me, retail, are net long because dealers are net short. Let's just keep it simple like that, right? Now, one thing to note, we're on NVIDIA, is that it's red, but it's decreasing. It's retail is reducing their long exposure, which is allowing dealers to reduce their net short exposure. So it's not continuing to be bullish. It's actually going the other way around. But it's not a short yet. The whale target for NVIDIA is 175 because we just got through that 160 whale support level. That was a whale target level. So as long as we're still above 160, we've got 175 on the table. If we break 160, then we've got 140, and we would expect to see something change in the dealer deltas. Okay. Wow, these dealer deltas are really negative in Microsoft. I would like to say that they're decreasing, but the day isn't done yet. We're kind of lined up with yesterday at this point. But since the day isn't done, we could get a day that closes much lower than yesterday, right? So it could end up being, one of these little events where it just drops right back down again. We don't know yet. So we don't want to make the assumption that it's trending back towards zero. And we are above the whale support, and there's not another one overhead, which just tells us that there's no big options position up here acting as a magnet or gravity or anything like that. We just don't have it up there. The fact that it's underneath this isn't necessarily a bad thing, but dealers are net short, so retail is net long, and I'm using the word retail, but look, it could be funds, firms, institution, it could be anybody other than the dealers are net long, right? So in Microsoft, longs are still in the house. That's not changing. I thought I could just click that, but I guess not. Fine. So we got Amazon is actually changing course here. Dealers are net long, so retail or everybody else is getting net short and it's increasing. That makes sense because we're in a little bit of a collar here. We've got an overhead target that's really close at 225, support at 220. Not a lot of wiggle room here, and it really is highlighted with this sideways price action. They are just priced to perfection here, and that doesn't leave a lot of room for you and me. So if we could get something really cheap, say, around that 250, or I aimed a little high here, around that 240 level, or somewhere to get this gap close, like that 195, I could play that game. But otherwise, to like buy or put or buy a call, I think the prices would be too costly and that we have no edge. So we've done Amazon, Microsoft, Apple, Google also coming into the green. So dealers net long just barely. And I will point out, that the dealers are just taking the other side of the trade. They're not driving price. We saw this same thing back here, and retail bought it up. So dealers went short. Same thing here. Retail bought it up. So, don't let this one green day spark your interest for, oh, retail's going short. Not necessarily. And just like Amazon, we're really tight here. The short side is 172, the long side is 180, and we're basically sitting on 175's support level. Not a lot of room here, right? It is worth noting we've got $5 difference between support and target, but $2.50 difference between support and lower target. What else do we have on the list? I lose track. Doo-doo-doo-doo. Let's see. Meta. We didn't do Meta. Same thing. Dealers are decreasing their net short exposure. So retail is increasing their net short exposure. Got a little scoop pattern forming in Meta. The concern is that it's right up against this previous level. And so that makes me wary, right, that we're going to get rejected again. We got all of this, we got an assumption of all of this pre existing liquidity up here. So when we dipped into it, we took a smackdown from it, and we didn't like crash and burn like we did back here. It wasn't that bad, but we did reject. So now we've got to watch this and see how we play that level the next time we come up into it. One, are we even going to make it back up to that level, or are we going to end up with a lower high? And then two, if we get back to that level, are we going to be able to break it and get through it, or are we going to get rejected again? In the rejection, will we end up setting a higher low? So we get up there and, reject, set a higher low, and then continue on, or we break that previous low. We don't know yet, right? And the positioning from the dealers just tells us that retail is shorting it or was positioning short, but we got a big update today. If retail is getting heavy short, they're getting run over today. For all we know, they're going to come in and buy back their shorts, and their buying on the shorts might be part of the reason that this is exploding higher. Maybe. Ooh, right into resistance too. Yeah, I like a short here. Let's go see what this price is at. I like it. Not exactly fair. Uh, Fair price would be half the width of the spread. So if you could work the order and get it for 250 or better, that wouldn't be bad. But trying to get puts on a day where we're up 2%, we should be pricing in at least half the width of the spread, and we're not. Now I'm willing to step out of the money just a wee bit, not much. And this is worse. We're out of the money and we're pricing really not much better. You know, for being out of the money even this much, we should be sitting where somewhere around like 240 or so. So they're wanting us to take more risk than it's worth. It's not to say that I wouldn't do it, but what it is showing that if we wanted like a really cheap put debit spread, we would have to go so far out of the money that it's not even worth doing. It's not worth that level of risk. Plus, look at the volume. I'm in September, so maybe if we try August, it'll get a little better. Not much, but let's see. Maybe 245. Still not getting 50%. 238 is not any better. And if we want to go far out of the money and get something crazy cheap, yeah, I'm not liking it. $45 for $10 wide, but we're all the way out at 600. We're looking at, a $140 drop in 37 days. And we're only priced in for a $75 drop. Though those numbers don't work, right? I don't want to spend $50 on this when it's twice the expected move and it's only based on this whale resistance and dealer positioning. We don't have a pattern. We're above the 4 still. This is a really nice scoop pattern and TRB setup. I just posted a TRB picture in the chat. So it owes us a move to the top anyways. Sure, it can stall, but if we were to measure things, we're above the half too. We need to break that 730 level. Then I'd maybe be willing to spend 30, 40, $50 on a short. But otherwise, as long as we're above that 730, I don't see a short here that I want to spend $50 on. Now, butterflies give us a chance to be short cheap. So let's see what we can do with some butterflies. $6 for a $5 butterfly. Yeah, let's see if we can widen that out a little bit. We'll try $25 wide first, 75 cents. That's a bit much. All right, we can get a 650 butterfly for $15 and then maybe widen this out a little bit. Just $10, $30. I bet if we work the order, we could pick this up for 25 cents, maybe a little more or a little less. They went 30 wide, didn't they? Yes, they did. Let's try that. Whoa. Yeah, they paid for that. All right, here's the butterfly that we just built. Not this one. That's some old save. Oh, it's skewed. Why? It's not supposed to be skewed. Duh. That's my bad. I'm missing a pinky. I can't count. It's $2.50. 30 wide on each side. Break even is 650. Or I should say the midpoint is 650. And as long as we get below, call it 675, you'll start to see profit. But that's still a heck of a move from where we're at, right? We would need the entire expected move just to get there at this point. See what I mean? But we could get there. It shows that we're right on the expected move. This would have a max payout of somewhere around $2,700. So, you could aim for like $300 to $500 easy. But I don't want to risk 250 to make 250, not on a butterfly, right? So let's skew this thing a little bit. We know we're not looking for a crash and burn. That was the wrong way. That's the right way. I moved it a lot and I did not get above the zero line. That's what I was trying to do. This would give us a position if I could have moved it far enough to where as long as we are above the apex and we never get below that level, we would have some form of profit. But I wasn't able to get it there. It maintained this negative ratio. It's not much, but it's still there. And I don't want that. So no dice. We could try a different expiration or a different strike selection, but at this point I don't like it. Maybe if we just drop that and drop that. That's now we're even farther from the 650 level. Yeah, I just don't like it. What's screwing with these options? Earnings. See how the implied volatility average is in the 20s and then bang all the way up into the 40s and then it starts to decrease from the 40s again. That's earnings. So we're looking at the August 23 or August 1st, August 8 expirations with the high IV. And when we come out of that, we're still pretty elevated looking at these August expiries. Wow, everybody's on the call side, huh? It's just not going to work. On to the next one. So one that we keep hearing about at Spot Gamma is SMH as a proxy for the indexes. What they keep saying is the Qs and SPY, their options are just really expensive and it's not worth the risk. And if you want to take a short or you want to play the indexes right now, rather than exposing yourself to that sort of level of cost, kind of like what we were just looking at with Meta, nothing was good there. Try SMH. I don't fault them for the logic, but they've been saying that same thing forever. Surely at this point, these prices have already blown out anyways. So what does SMH options look like? Let's see what's been traded today. 65,000 contracts, 42,000 of those were puts. So the PC ratio is at 1.8. It's nearly 2 to 1. All right. Looking at what's been traded, 36% has been spreads between the market on the put side. And 55% of the calls has been between the market. So spreads again. We want to see at the ask and above on the buy side and at the bid and below on the sell side. So if they were selling puts and buying calls, we'd see elevated, on those two metrics. Instead, they're almost equal. They're selling calls and buying puts at an equal price or an equal percent, not price. And they're selling puts and buying calls at a 2 to 1. That's about what it would take to buy calls. If you think about it, puts that far out of the money are cheap, and it takes two of those to buy one of those. But it's not 2 to 1. It's that's 14 and that's 3. That's like 3 to 1. The August 15 320 strike calls, which is what 40 points away, 35 points away. It's a long ways off. Whatever it is, it's out there. 1,500 contracts hit at the bid. Oh, those are spreads though. All right, well, let's take a look. Oh, yeah, much cheaper. First, just price the mid 240. I'd like to see, 245 there or a little bit better. It's I bet it's nickel wide. It turns into pennies way out here, but otherwise we're seeing nickels near the money. I bet this 43 wouldn't fill. I bet you'd have to fill it on a nickel. I would try for like 248, 250 because it's half the width of the spread. Um, I priced it as a buy. We don't want to pay more on a buy, but on a sell, we would want more, right? And it's the same thing. Cost wise, we would have wanted to see the same price there. But obviously, if you're buying the put, you want to pay less. It's a $25 expected move. So from 285 to 260, we should be buying puts somewhere around the 260 level for that expected move. And they are $3. I don't want to spend $3 on these. 255's got a lot of volume today. Almost, it is 50% of the open interest for August. And they are decreasing the position. So this cyan line is the open interest. It seems like they're decreasing the position. They bumped it up, so maybe they're buying, right? And this is another buy, but it had 9,000 in open interest, and then it dropped back down to 4,000. So they dumped 5,000 contracts. They may be buying it back up now, but seems a little skittish. There it is. Sure enough, they're buying it back up. Not in the same quantity, obviously, but there's the increasing open interest. So it's very likely, unless they're cutting this position today, like they did when they cut 50% of it back there, and we come in tomorrow and see open interest around 2,000, then then they just bought a big chunk of these back. So if you're looking for a play on the indexes, long or short, Spot Gamma says that these options are cheaper, that they are not as brutal as the index options are right now, and that they would be a better play. If we go up in the Qs and SPY, then SMH is going to benefit from that. Your calls will do good. And if we go down in the indexes, your puts will do good from here. That's their argument. Certainly looks cheaper, right? We're 37 days out and we're looking at calls at around 10.20 or 10.15 at the money. If we did that in SPY, well, I don't see the difference here, right? That's at the money, it's 10.15. I'd say Spot Gamma has sang from the rooftops often enough now that everybody's on the hook. But that was the put side. If you look at the call side, SMH has left side tail risk. The puts are more expensive than the calls, as they should be. Unless you're looking at commodities, that's the way it generally is, right? People are scared about the market going down. They buy more puts than calls. That's why puts are generally more expensive. And right now, puts in SMH are more expensive than the calls. Go back to SPY. Calls are more expensive than the puts. SPY has right side tail risk. People are pricing in uh, that the market's going to go up, and they're buying more calls than puts. And now calls are more expensive than puts. Supply and demand 101, right? So with that in mind, let's just nerd out here for a second. Oh yeah, TDEX dropping down into the yellow line. Puts are cheap. The bottom part of this chart is the VIX, which has just broke down below $16. And the top part is TDEX, which is not quite at $11 yet, but moving in the right direction. Both these are pointing to the downside, showing that put volume is down. That's the VIX, and that the cost of those puts are down, and that's the TDEX. So a lot of good information there, right? Which we just saw that in SPY options, so it's not a surprise. But if you didn't know what you were looking for, this would have told you what to look for, right? So that's a piece of the puzzle. We had TDEX. This is SDEX. I know, a bunch of nerd stuff. And this is also pointed to the downside. So this is your skew index. It measures the skewness or tail risk of the market, reflecting the likelihood of extreme price moves in the S&P or its related equities. Now, that's not exactly accurate. It's an index that measures the trades that are being put on and how people are positioning or what they think is the risk of a big move, right? So if you and I start buying a bunch of put options and positioning for this radical move in the options market, thinking that, say, SPY is going to take a 50% haircut and we're buying massive amounts of puts out of the money, this would start to pick that up. And it would say, wow, somebody's really positioning for some tail risk in the market. So it wouldn't be picking up, you know, the likelihood of an extreme price move. It would be picking up our bias of a likelihood of an extreme price move, right? Hopefully that makes sense. There's a big difference between those two. One of those means we have a signal saying that we should go short the market. And the other one is a signal saying that somebody already is going short the market, right? That's completely different stuff. Either way, what it's showing right now is that the market is not pricing in extreme risk. They don't see anything to be scared of right now. Look at April when we had Liberation Day as a real big threat in all of our faces. The SDEX was really high because everybody was concerned, and we were all worried that we were going to get these big outlier moves in the market. And that's how everybody got positioned. And then the president capitulated, the bond vigilantes took over, and now nobody's scared, and they're getting out of their hedges. That's some insight. Uh-oh, I broke it. There it is. So puts are cheap. The put volume is down, and that's because everybody is getting out of their hedges and see no threat to their current market position. I think I already got that one on. Yeah, I got that one on. The cumulative volume index is still showing net buying. So that kind of reaffirms what we were just looking at. Everybody is long, and they are continuing to stay long even in the current backdrop. You can shop around for those puts because they're cheaper than what they were, but long is still the better play. As much as it doesn't feel good, and we're at highs, and there's all these bricks in the wall of worry saying we shouldn't go long, there's no short signal out there. And positioning is still long. And there's just no other way around it. And there's no signal against it. All right, we got a little bit of an uptick right at the end of June. And I mentioned that with an article this morning. I shared it in the chat about the Fed coming in and playing save a hoe in the repo market at the end of June. Now, the article did say that it was not a one off. They saw that in September, which was another quarter ending event, and that they said, look, it's just one signal by itself, and that while it is a signal of liquidity or lack of liquidity in the market, that it was a one off because it was the end of the quarter, and that we need more information. So this little bit of an uptick in the Bank of America credit spreads, it's just one single shot right across the bow, and I don't think that's going to be enough, right? So it is there. This was a pretty good sign that we were going to have a rough week when we got that dip, but it's not giving us any answers because it's the same pattern that we have on the S&P and the Nasdaq. We pulled back and we haven't been able to run back up and break that high that we set already. This isn't doing it, the indexes aren't doing it, and that's not giving us any clues. If we had some divergence where this had gone down and the S&P and the Nasdaq had not yet gone down, that would have been a good signal. We would have known to like get out of some longs, maybe put on some short-term shorts, but we didn't get that, right? So that's not helpful. In fact, this chart on the right side is the S&P, the Nasdaq, and this ratio chart. It's all three. And look at them. Their shapes are identical. They all pulled back the same day, and then they all stalled for one day, and now they're all up one day, and none of them have breached the previous high that was set. So not helpful, right? It didn't hurt to look, but if this was going to give us any value, it would have been divergent and I would have gotten some value out of that. Otherwise, I've got a chart that draws out all of the candles. Looking for that. Yeah, TradingView right now has got about the best candle analysis out of all the tools I have. TrendSpider is not bad, but their charting isn't as nice as this. So it's like hassle free here. Maybe it's this chart. Maybe it'll do. So this is running a couple of different programs. One is I've got it looking for these bearish engulfing bars, and I have it looking for dojis. And then it's also drawing out any price patterns that it sees along with price targets that go with it. It is also forecasting the next move. And what I like to do with these when they're paired this way is to see if this forecast is divergent from this price target. If it is, then I know to be more wary of this price target. But if the forecast matches the price target, I like it better, right? Still doesn't mean I'm not gonna run in there and trade it or anything, but it's just nice being able to synchronize those two. Takes a moment to load, and you could add more candle patterns like shooting stars and morning star reversals, evening star reversals, those sorts of things. The what I don't like is how it still carries this old pattern. This range here had a breakout price target way up here, and we got near it, but it failed and it's done, right? Like you just don't get there all the time. It didn't get there. It's done. It needs to remove that. Otherwise, new traders are going to see this and say, "Oh, we can still go up here? Maybe we can, but it won't be because of that pattern, right? It'll be for some other reason. That pattern is done. So it would be nice if it would remove it and just recognize, like, hey, that is done. It removed all these old ones. You don't see any back here. And then for the Head and Shoulders, this is a good demonstration that these tools don't give you the high probability stuff. When you measure a Head and Shoulders, for an example, 50% is the highest likely outcome, not 100%. And that's what I would be aiming for, right? Is 50% of the head to the shoulder. Even if we measured the whole thing, I think they exceeded that measurement, right? I would take half of this. And I don't know what they measured, but either way, I don't like their target on that Head and Shoulders. That just seems like fantasy land. Still, having these auto drawn patterns really helps get you to the point where you're seeing these sorts of patterns on your own. The bad thing is a lot of the patterns that I trade, they're not these really big ones. They're OCR style analysis where you really bring it in and you look at, 2 and 3 bars, not months worth or years worth of bars. Because, short term trading using, August or September options, we want to use 8 to 10 bars, not 8 to 10 months of bars. Really wish it would quit messing with my color scheme. Driving me crazy. Well, so far the Microsoft breakout is holding, and so is the Meta breakout. Tesla's so broken. I don't even want to mess with this thing. If we should be positioning long in the Mag 7, as much as Apple's a just absolute dog right now, I think I'd rather be long Apple than some of these other names. But the takeaway is that everybody is still positioned long and that there is no heavy short positioning out there. And there's no signals for any heavy short positioning out there. The flyer would be if you are thinking about a short, nobody's positioned for really bad news, right? Like, kind of think that over for a little bit. In hurricane season, we see people buy extra homeowners insurance and just storm insurance. They prepare for the worst. Right now, the market is so immune to the headlines and the drama and the threats that they're not even carrying additional hedges or just straight up hedges. If we do get some really negative moves, those puts are going to swell up fast because everybody's gonna scramble to buy them. So there is that, right? I guess that's what I would be focused on if you're looking for shorts. You could probably get just some far cheap out of the money stuff because if we crash and burn, puts are gonna rip. What's the VIX puts looking at right now? 37 days out in the VIX, which would, that's literally just the VIX. They're running at about the VIX is less than $16. About $15.80 for the VIX. Hey, check that out. Ain't that neat? How did we know that? Right? Go back to the SPX and look at the 30-day. It's $15.88. Well, 89 cents. That's the VIX, right? So when you're looking at the SPX, you don't have to go over and look at the VIX. You can just look at that number right there. That's the VIX. So what's the VIX puts trading at? Can't get them now. The market already closed, but there's always tomorrow. We want at the money. Got to kind of think this through. Where's at the money? Don't let the options lie to you. These are not at the money, right? Because we're in the VIX. We got to check the 30-day VIX is 1625. I like that 1925. It's a little farther out, but it is a more accurate reflection of what we want to focus on. Because see the last on that. That's why I don't trust this 1625. It's on the bid, but there's been no ask, no net change, no last, no nothing. So skip that one and focus on this 42 expiration. At the money is $19.30. So now we go back to the VIX. I was in August 20, I think. I think I was. We want that. That's out of the money, right? Or that's at the money right there. $2 for a VIX call. We don't want to we don't want to spend too much. So we could sell some puts to buy these calls. But we're not alone, right? Look at the volume today. 1950. They went up another 50 cents higher than what we were already looking at. But you see that they got the same answer that I did. They went in and they asked, where's at the money in the VIX? And they went right over here and they said, oh, 1930. I guess it's closer to 1950 than it is $19 flat. They went back into the VIX and they bought at the money calls. And at the money calls would be 1950 right there. 44,000 contracts is what they bought. All open today because we only had an open interest of 3,000. So if you're shopping around, those look good. 1950 strike calls for $2, and you could turn it into a spread just to, lighten your load a little bit. It's 50 cents for $15. That's $3 wide for 65 cents. It's not bad. I don't think I'd want to cap it though. I think you're just better off spending the $2. Now, look, this is a trade that says I think we're going to crash and burn, right? If we just slightly go down in the markets like what we've been doing, the VIX is not getting juiced. They're just not coming in with any real size. So that's why we're not seeing those metrics change. The market's going to have to get scared and come rushing in to buy the VIX to make this trade work. Otherwise, it's going to fade and decay, and you're going to be out $2. So just keep that in mind. And if you did want to shop for something, far out of the money, give yourself a little bit of time to maybe use September's expiration and something like a 30 strike or something that cost $1, right? 34 strike way out here. You can see where they're at, 25 right there. Just kind of, point you in the right direction. But we don't know if that's open or close because the open interest is so big. I like where we were. We know it's opening. They are buying them August 20 calls for $2. That's what I got for you guys. Unless you got any questions, I'd say let's wrap this up and get the evening started. All right. Well, everybody, have a good evening. Um, as always, if you guys got questions, you got something that you want to discuss or evaluate, hit me up. We can cover it in Friday's stream.